Hello, this is Japanese Economic Review Channel. Welcome to the June 2026 executive briefing on the Tokyo Metropolitan area's new condominium market. Today, we explore key trends, including unyielding price growth and regional shifts. Incorporating data from the Real Estate Economic Institute, we highlight how the market adapts to a new 100 million yen baseline. The June market is defined by persistent price inflation and tightening supply. Average prices firmly hold above the 100 million yen mark, with per square meter prices rising for 14 consecutive months. Meanwhile, overall supply declined by 4.7% to 1,564 units. We are also seeing early friction, with unsold inventory rising for the first time in 6 months. Looking at the macro dashboard, the average price hit 101.37 million yen, up 10.6% year over year. Liquidity remains moderate, with a 62.5% initial contract rate, but the backlog of unsold inventory ticked up to 6,389 units. This dynamic suggests that supply drops are compounding price hikes, creating a heavier burden on the market. A stark geographic divide is emerging. Tokyo's 23 wards saw an 18.2% drop in supply, and Saitama plummeted by 43.7%. In contrast, Kanagawa is thriving, absorbing demand with a massive 76.4% contract rate and a 50.5% YoY price explosion to 103.79 million yen. Buyers are clearly shifting to high-spec suburban markets to find value. The ultra-luxury core, Tokyo's Central 6 wards, operates independently of broader constraints. Despite a constrained supply of just 82 units, the average price reached 214.30 million yen, or 3.43 million yen per square meter. This tier continues to pull the greater Tokyo average upward, driven by wealthy buyers unaffected by market friction. The 100 million yen plus tier is not an anomaly. It is the largest volumetric bracket in the market. In June, 503 units, nearly a third of total supply, were priced over 100 million yen. The fat middle clusters between 55 million yen and 90 million yen, leaving a distinct gap. The market's main battleground has fundamentally shifted to the high-end segment. Analyzing product profiles, 3 LDK layouts remain the market's backbone, comprising 970 of the 1,564 units. Regionally, Tokyo's 23 wards absorb compact units, while suburbs focus almost exclusively on 3 LDKs. Notably, 85.4% of all market units are flat 35 registered, indicating that strong family demand is still a foundational driver. High-rise towers show exceptional resilience. June saw 18 properties and 482 units released, capturing roughly 30% of total supply. Their contract rate hit an impressive 73.4%, outperforming the 62.5% market average. This segment remains highly liquid, defying the slight cooling trend seen in standard inventory. However, buyer absorption is showing minor friction. Unsold inventory reached 6,389 units, the highest in 6 months. The initial contract rate slipped to 62.5%, down from May's 64.9%, and notably, 0 properties achieved same-day sellouts this month. Historic price highs are beginning to test the limits of general purchasers. Looking ahead, we forecast a pipeline bounce back to 2,000 units in July. Entering the second half of 2026, the market is defined by high price inelasticity. The critical metric to monitor is whether these 2,000 units can be absorbed at the 100 million yen threshold, or if unsold inventory will compound faster. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.